Okay, there we go. Welcome. I am Tim Quast with Market Structure Edge, and this is the live demo and discussion for December 21st. We're almost out of 2023. Part of it, I'm not sorry to see go, but it's a lovely afternoon here in Steamboat Springs, Colorado. That's where I am today. We're up here for the holiday season, and we could use some more snow. It looks like we could get it. We'll see. Conditions for me being spoiled. So the Mount Werner's right out there. Behind me is Howelsen and Emerald, but there's a ski resort right over on this side. The longest continually operating ski resort in the United States had big Olympic team ski races last night. The whole U.S. ski team was out there racing last night. It's quite something to see. And it's just right across the river. And then Mount Werner is out this way. It's a lovely place, and we have great restaurants, but don't tell anyone. Our town fills up. Okay, so let me get to the things that I would like to cover today. I've got 5 items on my list. Brian wants to cover an item 2 today. And what I try to do is discuss the things that we talk about in the market desk notes. I want to talk briefly about why did the VIX resets affect the market yesterday? Again, you can't say absolutely. I'm not saying it's precisely the reason. John, you and I traded notes about the things that are behind it. But I want to comment on that briefly. I want to concentrate on entries and exits, some mechanics of using volatility, one of the core things that we do, stops and limits, because Amy brought up a great point about those and how easy it is to be stopped out. And then a brief word on what's next. That's sort of the plan. So let me share my screen. Bear with me a second here. Okay. Okay, so this is the Edge dashboard. If you're new and you're hoping to Brian, can you let that individual in? Thank you. And if you're looking for the real basics, I would point you here. We can always hit a little bit of the basics. I would encourage you to go to How It Works, which will take you to marketstructureedge.com. We have a series of videos that will cover basics like creating dynamic or static portfolios up here. And what does the dashboard tell you? Everything we do is predicated on a basic economic principle: demand and supply. When demand increases and supply declines, prices tend to rise. If you're looking at shorting the market, if supply peaks, if demand peaks, and supply rises, probably those stocks aren't going to do well. There are hardly any in that 75% short portfolio, but you can set those up very easily. You can go create a portfolio that has various characteristics, such as if you want to find stuff to short, for instance, you could go over here and say, well, I want to find stocks that have where the supply is greater or equal to 75%. What that means is that 75% of the trading volume in these stocks is coming from borrowed or created stock. Let me see what we get. And we get 19. That's exactly what I have in my portfolio. Those mechanics we cover with some small videos if you're new. So now I'm going to cut to the mechanics of using the platform here. Briefly on why the market plunged later in the day yesterday. We warn folks around options, I will say expirations, but resets, and particularly monthlies, because the monthly events, and we have the 23, 24, I think even the 25 calendar. If you go to marketstructureedge.com and you click on resources, you will see the drop down, the calendar that comes from the Options Clearing Corp. We do some personalization to that calendar data, and we include them there. But just realize that about 20% of market cap depends on derivatives. It is a right but not an obligation. Buying and selling volatility, all kinds of ways to describe this. But a small change to that can have a dramatic effect. It's implied supply and demand. And what I believe happened yesterday, I can't say absolutely. We just weren't surprised that there was it could happen again today. Again, I'm not saying it will. But when you get to VIX resets and everybody has been selling volatility, that is, let's say like a buy right strategy, where you buy equities and then you write a put or call to generate some additional income from it. When the bias is toward wanting to sell volatility to somebody else, and the market has been rising, and the VIX instruments, which are a representation of implied volatility, might be used by large institutional parties in that market to hedge their exposure, are resetting, and everybody wants to sell volatility, but nobody wants to buy it. What could happen? Well, you could have a supply demand imbalance. And I think that that's what happened. There was a lot of desire to sell volatility and a modest desire to buy it. And that imbalance caused the institutional parties to say, well, I've got this inventory that I'm holding to sell a call or a put against, and I don't need it. So I'll just get rid of it. And that way I don't have to pay for VIX insurance for the next month. And the whole market can tip over. Look, I'm not, if your head's kind of spinning, that's all market structure, the regulations, the mechanics of the market in context of how the US equity market works today. I think that that's why we're very careful around options expirations periods. And they'll show up, these little green squares that you see on broad sentiment. That's the historical dates for options expirations. Here was VIX expirations that completed this period. We jumped when they started and we dropped when they finished. Again, I think that that's just a reflection of how these instruments reset. Now, I don't know what's going to happen ahead. The data are pretty good. We have strong demand and falling supply. Generally, that's good. The trouble is we've had strong demand for a very long period here. This is all the way through two derivative cycles. And it's kind of unusual for that to happen. Generally, when we have a very long period like this, the end of it is very abrupt. I don't know what's going to happen, but you just want to be, the informed are aware. If you are risk intolerant, then you can just sit out during those times. I don't sit out entirely, but I'm careful about what I do during those periods of times. So that's what our thinking is. It's why we said be careful around this conclusion to the options expiration cycle. Now, let's get to entries and exits, the mechanics here. I think the question I get more than anything is this is really interesting to look at supply and demand, but how do I specifically use it? I will look at the momentum portfolio. The momentum portfolio, by the way, is here. I'll show you. If we go to system portfolios, you can recreate this. So I'm just going to show you what's in here so you could validate it. If you want to look at the criteria that we use, we look at market structure sentiment that's not equal to down, but that is greater or equal to 8, right? So it could be topped at 10, and that's fine. Strong, it's a normalized scale, 10-point scale. It's an algorithm that meters the way trades are executed. We consume trade execution data to do this, and the rules, the rules determine those outcomes. Brokers have to meet best execution standards. They have to report how they route trades around the marketplace. It's why I can see where my trades execute. You could always ask your broker, give me the 605 data on how you handled my trades. We have to do that, right? So that factors into how we look at these data. And it gives us a measure of whether there's more buying than selling or vice versa. And we like strong standard deviation. So one standard deviation separation between supply and demand, and volatility. Volatility, the way we look at this, is the average movement between high and low prices over a 5-day period. It's 5-day average. A good way to think about it, though, if I'm using entries and exits, is I'm going to think about what's what's yesterday's closing price and what's it doing today? Is it moving? Where is it? What part of that volatility is being consumed? I'll show you. But here, if you just want to get a snapshot of what those criteria are, there they are. And with the momentum portfolio, we are looking for short-term, modest gains with high probabilities. That's what we're after. It is a far less stressful way to make returns as a short-term trader than it is trying to figure out, well, what's something going to do? The probabilities are very high in this group that they will perform well. Here's something that I do with this, and I'll show you the mechanics of entries and exits. So I will go here, and if I'm just going to trade short term, I might sort by volatility. Now I've got the most volatile stuff at the top. There's more risk in those, but in a sense, I could say, well, in a perfect outcome where I got it absolutely right, I could make 6% in a day in SoFi. I'm not after that much, and you shouldn't be, because that's a low probability. But what about a third of that? That's often what I aim for. In this whole group, if you could get 2% and you repeat that over and over, it's a very successful way to approach the market. And why does that work? Well, because most of the prices all stocks have to trade between the best bid to buy and offer to sell. They will never be the same. The spread might only be a penny, might be 10 cents. And brokers have to execute trades a certain percentage of the time between the best bid and offer, or they get in trouble. And that's caused a concentration in order flow, by the way. 4,000 brokers regulated by FINRA. In the data, about 8 of them are executing most customer orders now. That's excluding the proprietary traders like Citadel and Hudson River Trading and GTS and QuantLab and Tower Research and Infinium and so on, who are not handling customer orders, but they're interacting with them, and they'll set prices. So they know the most about the prices, and they have a range that they'll trade things in. And if we're between those, we have a competitive opportunity. We're not going to outcompete Citadel. We're not going to know more. We're not going to have better data, but we can understand what they're likely to do. And let's use Snap as an example. I had ARM up here, but let's just, Snap. I traded Snap. It was a great trade today too. I was just too busy doing things. But here's a great example of how to use the data. Notice that it's up 3.6%. So if you look at the portfolio over here and you look at Snap, what's it move on average? 5%. Well, it's a pretty good amount of it. And so how would you capture part of that? Well, you have a pretty good idea when you look at the supply-demand balance, which way it's going to go. If broad market sentiment shows divergence and is strong, that we know that the bias is to the upside. Look at how strong Snap has been the whole time that it has it's had demand at 10. It has done well. Didn't do as well when supply was pretty high, but as supply declined and demand remained strong, then the price really took off. And so yesterday the price was down. I traded SoFi yesterday, but I left early because of the VIX, and the day before that I traded Snap. This probably produces gains. Probably not going to be 5%, but it'll be some portion of that. So now you have an idea of where you want to be. I really use this simple an approach. If I know that the closing price is, what was it? Is it 19? No, it's 1630. Was that what it was yesterday? And I want, let's say, half, or maybe it's 2% of that. Right. So if I want 2% of that, if I bought it at my X is going to be around 1630. If I bought it at 1597, let's say it went down 2%. Doesn't have to go all the way down there. It might be just down 0 on a good day. Let's go look at what Snap did. So it pulled back from its opening. It declined some. It's still above its the preceding close, but I know that there's a high probability that it's going to move at least 2%, maybe more. And so you don't have to be perfect about your entry point. You just need to understand, if I'm going to capture a third or a half of that volatility, that I need to think about how much the price moves. If it hasn't moved and the market is moving, there can be a reason. Early in the day, there's going to be a lot of money that is at an average price, because that's where prices have to go. What lies between the best bid to buy and offer to sell? Average prices. They could be pegged, they could be volume weighted, they could be floating, they could be time weighted, a TWAP, all of that. 86%, give or take, of all orders in the market are derivations of midpoint. So that stuff will happen in the open and it will happen in the close. And so if the market, if it starts high but then fades, there's a good probability you can get some of that back. You don't have to get it right. But if you bought it anywhere in here, in that range, and you wanted 2%, you would have gotten it, right? And statistically, we know that that happens when those conditions are right. Broad sentiment is strong. The supply-demand balance is good. We know what volatility is. It meets all of our momentum characteristics. It's going to be close to 80, maybe even a little better percent of the time that that's going to work. And so that's what I will always look at. And I don't spend a lot of time. I like to do this, sort them by volatility, go look. SoFi yesterday was an ideal choice to me. It was down a third of its volatility. And I bought a bunch of it. I tend to buy it at the market. I pointed this out in let me see if I can show you this. Bear with me 1 second here. The market is illiquid. There's not a lot available, and so prices are very unstable. Bear with me 1 second here. I got to admit myself to this application. I just want to show you this. That if you look at let's use SoFi as an example. If you look at the what's available at the bid and the offer, so there you go. There are 27,000 shares at the bid and 87,000 at the ask. How much could I buy? Well, you would think that much. It's not that easy, but I know how much it trades, and if it's down a third of its volatility, and I can get it's a penny spread, tens of thousands of shares, I'm going to put a marketable trade in. Might buy a bunch of it. I might buy 1,000 shares or close to that at a time, and I know I'm going to get I will get some price improvement out of that. It means that the trades are very fragmented. I pointed out that when I bought and sold SoFi, look at how many trades it took. I mean, if I add up the amount of trades that I did in SoFi and Snap, there are almost 50 trades to get in and out of things. And it went all over the place. IEX, DirectEdge, MEMX, ARCA, the NYSE Island, which is a Nomura facility. It's all fragmented. Well, I know that. And you say, well, what does all this have to do with entry points? It's why prices are unstable. It's why there is volatility. So I know if this thing hasn't moved on a good day, I can probably buy a bunch of it at the market, and the price is going to move in my favor close to 90% of the time. I'd be happy with a small gain. Yesterday, it just stopped rising. I didn't want to be in the market by noon Mountain Time. I wanted to be out because I don't trust the VIX expirations period. And so I took 1%. Okay, well, that's fine. Just be happy with those little gains. You add up those little gains over time, and it's very effective. It beats volatility in your portfolio. So I'm just going to finish back here, and then we'll come to stops and limits. That's really how I think about it. Whatever the closing price is, I'll look at what is half of the volatility. Doesn't mean I'm going to wait for it to go down. It may not. I can't control that. But if I know that the whole market is pretty strong, third will be fine. Even flat is fine, but then I've shrunk my expectation of the return. If it's down like Snap was down fully half of its volatility. I thought, wow, that's an amazing opportunity. And I bought it right at the market. The market opened, and I put in a stack of marketable trades. And then I left as soon as, in 4 minutes, I made 2%. That doesn't happen that often. It's not the point. And I'm explaining these things because I use this very same mechanics that I talk about all the time, and they're very effective if one understands what all is occurring. Okay, so now let's go to stops, and I'll pause there in case there are questions before I address stops and limits, which we've talked a lot about. Whoops, sorry, I just killed myself there. Comments, thoughts, questions before I continue?
One question there, Tim, from Alex.
Okay, Alex, good to see you, Alex. Are we able to view prior days tickers in the various portfolios? It's a routine question, and the answer is it's challenging in this particular platform. Version 1.0 of Edge, we could do it. You could just go change the date, but it was a different structure. So the answer is no. Currently, I wish you could. It is one of the things I'd like to be able to do, right? So you could go back and say, well, what was in this portfolio? If we went back here, what was in the momentum portfolio last week, for instance? that's going to take some work. And this is Azure Blazor, and it just pulls and furnishes data based on what a user is doing. And so changing the date is really challenging because we'd have to change it universally. So we'll figure it out. And John Cook's probably got thoughts, but I will. I know it's on our development list, but it's like 20 items down. So we'll see, Alex. It would be helpful. I don't disagree. Bob, yeah, I think that John Cook, that's what you do too, to get some of the views, save the files every day. It's suboptimal, but you can do it. It's pretty easy to do this. If you click through here and you go to, as soon as it loads here, you can kick this out to Excel. And it's clunky, but it will get you there. Okay, stops and limits really quickly. Amy, what you said is, I bought Snap and I got stopped out of it. So how do you set those so that doesn't happen? And I've had a lot of trial and error with stops and limits, as this audience knows. The not using them. I have 3 or 4 disasters that I've had. One of them was back in January of 2022, and I owned Netflix, and I should have left. The supply demand equation had changed. I did not put in a stop. I left, and I went on a sailing trip, and boy, did I pay the price for that. Then I went through a period where I was setting my stops and limits too narrowly. That I don't want to take any chances. I don't want to lose any money, so I'm going to set it very close to my current price, and routine. I was just getting stopped out or limited out all the time. And how does that happen? The all limit orders are hidden liquidity, and Citadel's algorithms are going to know within the volatility to go look for them and trip them. I mean, I'm picking on Citadel. It's not Citadel's fault. They just are a major market maker, and anybody could do that. So if I'm going to, I only set stops and limits if I'm leaving. If I can't watch it, go to walk the dog or something, then I'm going to put in a stop and a limit because I want to take chances. I could, trade on my phone too. But why don't I? Because all stops and limits are somebody else's prices. They're not yours. So somebody's going to determine whether they fill your trade. I don't like to tip my hand. I know marketable trades have to be filled by law, only in a certain increment. But if I hit the top of the book with then my trade is very likely to be filled for the best price, and I don't want to tip my hand unless I have to. All those stops and limits do that. So how I look at that is, if I'm going to have to leave and I bought Snap down half its volatility, which, if it's 5%, it's 2.5% down, I have to put my stop at least 50, maybe 75 basis points below that. Well, it's a lot of risk. So I don't prefer to do that. Then if I'm going to do that, maybe I buy later in the day, so I don't have to have that exposure for so long. I strongly encourage you to protect yourself, but realize that your order becomes liquidity. When it's a limit order, it becomes liquidity hidden somewhere in the market, meaning it's not clearly at the best bid or offer. It's below those, but it's out there. And somebody's going to search for those things. And it's not that your trade stands out, but we're humans. We do similar things, and it's going to be there. So what I would say, based on my own experience, is if you're trading volatility, and you look at the amount of price movement there is in a given stock. Now, if I just take Natera here, it moves 3.5%, and if I bought it down 1%, well, there's going to be risk in that. Do I put my stop down another percent? Am I willing to take that kind of risk? Probably. I feel better taking that risk on 4 or 5% volatility. But I think you have to put a big enough gap that a machine has to be a little bit of an outlier to find your stop. On the limit side, really the same principle applies. If you want to get limited out, then set your limit less than 1% away from your current price. You're probably going to get limited out. But that's how I think about those. Comments, observations. I mean, many of you are veterans at this and may have some good experiential thoughts. No, Barry Norton? I figured you'd have words of wisdom.
No, I'm in just cruise mode because it's just too unpredictable. This time of year is just
Yeah.
too unpredictable. I got lucky waiting for yesterday's reset on some stuff that was short, but it's mostly just been letting things run and playing with covered calls for the next, for this week and next week.
Yep. Okay. Let's see. I said, okay. Let me, Anthony, did we answer your question? I was at the VIX calls to put was 3-1 yesterday. Yeah. Yep. Well, and I think that's part of the problem, Anthony. It's part of what I described, that I think if everybody wants to buy calls to hedge on the VIX and sell calls on positions, there could be a big imbalance. You get a supply-demand imbalance. It's very difficult to predict, even with the data that we can see. We have a pretty good idea what the market is likely to do by looking at the supply-demand balance. But at options expirations, it gets very difficult because they're black holes. You can't see the whole thing. Okay, so that covered markets, the mechanics of. I've got all the way, I think, to the last thing. So Brian, you wanted to talk a little bit about this. We use this term BCD. It's just an easy way to remember: broad market sentiment, context divergence. And Brian, I'll let you take the floor for a moment. I'll wrap up with a couple comments about what we see ahead.
Sure, thank you. Appreciate it. Hi, everyone. Good to see you all again. Some of you, perhaps the first time. As Tim mentioned, I've been with the team here for quite a while, but great to meet you all. Well, I wanted to, as Tim mentioned, wanted to share a little bit about what we call BCD. When I was thinking about it, I kind of thought about it in terms of kind of like the rhythm of the day. As you're getting into your rhythms, I know you all probably have different ways that you kind of attack the day, and I have a series of spreadsheets that I keep. But you can do this pretty simply. You can. I'll always start out here with broad market sentiment. Where are we right now? And for newcomers, what we're looking at here, this is sentiment in green, and you can see right now we're elevated. We're 6.9, well above 5. One way you can think about broad market sentiment: if you're above 5, that's generally going to be a constructive environment for gains in the market. Well, we're well above those levels, and you can see that short volumes are very low. So right away, as Tim had mentioned earlier, you get a good feeling that this is a constructive environment, for appreciation. That next part of it, the context of the market. Where are we right now? You can see last week was options expirations. Friday was triple witch expirations, S&P index rebalances. It was a big day. We made it through that okay, and then wham, yesterday got hammered at VIX expirations. Well, the lesson is we weren't fully out. And if you remember some of Tim's notes and my notes over the course of the last week, we had mentioned, this is still a little bit unstable right now. We're not through expirations. So, keep your, for me, that means not holding overnight positions, just being careful. If you want to trade that intraday volatility, go right ahead, understanding that, the context is upside for the market, but there is that risk like we saw that was occurring yesterday. And then lastly, and this is a great way to look at it, is just divergence in the market. Are we seeing demand up? Are we seeing supply down? Or if you like to short stocks, it's exactly the opposite. I know we had an IBKR webinar about a couple weeks ago, in regards to shorting stocks, and you can do that. And I'll show you briefly what mine is. It's just the opposite of the momentum portfolio. I have absolutely none in there right now. That's very telling about the market. And this is what my short portfolio looks like, if anyone's interested. But I just took the volatility components and I just inverted them. That's more just a FYI. That's BCD. Tim, if you're okay, I was going to cover just a couple of comments about what I see ahead. and that might kind of dovetail with what with what you're seeing as well.
Have at it. Yeah.
I'll back this look up. Actually, I'm going to back it up our maximum range. So what I'm looking at here, and I'll point out two different time frames here. We're coming into month and year end. The market's had a very nice run, and obviously this is a very nice run as well. And looking back, two different periods to point out in terms of where do we go for the next week and a half. And if you look back in 2021, we had a strong run into the end of the year, and we basically immediately gave it up afterwards. Now, I'm not saying that's going to happen in the beginning part of 2024, but the point is, a lot of times at the end of the year, think about it in terms of context of what market participants are going to want to do. If you're an active investor and you've had a nice run and you're going to send out marketing materials during the next month or so, well, you're going to want to, it's called window dressing, where you're going to want to dress up your portfolio as best as possible. And a lot of times that will mean buying additional winners, perhaps selling your losers, and making those portfolios look as good as possible. Do we have a similar run this year? Good chance, especially with demand up and short volumes lower. I'll point out one other period where it was just the opposite. That was going back to 2018, and the market just came under a tremendous amount of pressure. It's a little hard to see on this graph, but we went from 291 on the SPY, and by the end of the year, we were all the way down to 230, 240. December was just a very volatile month. Can we see pressure at the end? Sure, but if you look at this example back in 2018, look at what was happening at short volumes at the same time. They were exceedingly high. That's not the environment we have right now. If you look at our short volume setup right now, it's going the other direction. So I guess my takeaway when I look at this setup right now, I don't think we're going to implode going into year end. If anything, maybe we trade kind of sideways here for a little while. And I'll share one other item with you. I've shared this the last two times we've gotten together, but I think it's important to think about. I won't go through all this data, but briefly what you're seeing here is the last 4 years when we get above that red line or we get kind of stretched. What's the average performance in the marketplace? Well, the last 4 years, it's 70 basis points. So that's one way that you can think about the environment that we find ourselves in right now. We're a little stretched above that red line. It usually doesn't mean that we implode. It usually means that we kind of trade sideways from that point going forward. So with that, Tim, I will give it back to you. And you're muted, Tim.
Yep. Sorry about that. Thank you, Brian. Appreciate that. One thing that I didn't mention that I would like to point out is if you're not a short-term trader, look, I have long-term investments and private investments, public equities and fixed income, and you could use this for both. You could, if you want to modulate your exposure to the broad market, to sort of segue with what Brian was saying, you could see when you want to increase or decrease your exposure to equities, and you could do that. I've got managed accounts, and I certainly offer my input and say, if I look at the supply-demand equation and they're not good, if demand is falling and supply is rising, I will say, well, we probably want less exposure to equities. It's not that you juke and jive, but it can help. A modest difference in losses versus gains is very material because the market is volatile, and so that's something to think about. You could also do a small long-term portfolio. This is just an example where what you do every day is you look to see if the things in your portfolio continue to reflect the conditions that you want for holding them. And I just have this little handful of 6 items in here. So this is what you could do. You could have a mix of what I would call low volatility stocks that spend a lot of time at 5, like Apple. You know, when do you want to hold Apple and when do you not want to? And all you have to do is check periodically and see whether the supply-demand equation is favorable or not. And so right now it continues to be favorable. If supply rises above 50%, I would say leave Apple and you can always return to it. You don't miss out. All that matters is the price that you pay for something and the price that you sell it for. And prices are wholly relative today. I don't care what the price of something is. I care whether the supply-demand balance is favorable and if I get a good entry point and a good exit point, right? That's all it comes down to. If you're holding momentum stocks, so long as they're at 10, I mean, you can stay in them. So long as they're above 5, they tend to do well. If here, this is GitLab. If supply approaches 50%, if there's any decline on the demand side, I would remove that from the portfolio and then take that money and go find something else to replace it with. And that's a long-term approach. You don't have to check all the time. You don't have to worry much about volatility. You could even sort to take volatility out of the equation. Say, well, I only want stocks with less than 3% volatility, let's say. Those are all things that you can do to improve your performance versus the market, and those are longer term. I use Edge unequivocally for short-term trading. And the way that we think about this from a probability standpoint. If I want small gains in a market where I don't know which direction it's going to go, the probabilities of making 1% in 1 to 5 days in stocks that have steady demand at 5 and falling supply in our tests, and as we complete these, we'll share them, are over 80%. Small gains. That's not where you're going to go get a big gain like in momentum. And in momentum, a 2% gain is very nice. Repeated. If you could get 2% a couple of times a week, it's a very nice return. And that's the way to think about it. Wrapping up with the broad comment, I can't really add much to what Brian said. I agree. If I look at this data, it looks good. The market has done exactly what the Federal Reserve signaled, that if we are going to have a very accommodative approach to monetary policy, then people are going to increase their global macro exposure to equities. And how will that manifest? Well, in sustained strong demand and sliding supply. Global macro funds will shift from more short to more long, and it shows up in the data. What is the risk in this equation? Well, the risk is that something goes awry. One data point can affect this, and I don't know what that would be. I always get concerned when demand has been this strong for this long. When that turn comes, it tends to be violent, and most of the time, broad sentiment is predictive, meaning it tells us beforehand what's going to occur. In those situations where something occurs before the data tell us, it tends to be related to derivatives. And derivatives are the things that get out over the skis in markets that have a lot of demand and limited supply. So I look at this and say, well, today is the conclusion of the December period. If something's going to go wrong, it will go wrong between here and year end. I don't see that in the data, but I'm aware that those risks exist. And as you know, maybe Barry Norton has got it right, that if you're risk averse, it's a good time to sit on your hands or go do something else. And I'm content too. If I see good opportunities for short-term trades, I'll continue to do those. But I'm wary that this thing will break down and it will happen suddenly. Don't see it in the data, but just beware that that's something to think about. Okay, that's all I think we've got. Any concluding comments?